Right. Well, welcome everybody. This is a jointly organised Hong Kong Institute of CPAs and Hong Kong University of Science and Technology webinar on TCFD-based reporting of capacity to transition to net zero carbon emissions. So TCFD, the Taskforce on Climate-Related Financial Disclosures, published its recommendations in 2017. Over 3,000 organisations have signed up as being TCFD supporters, and some companies have done substantive TCFD-based reports. And I'd like to do a call out here for CLP, which published, together with their annual report, a separate 28-page report on their climate-related disclosures based on the TCFD recommendations. So it's being done, but only, I think, by a relatively few companies. Another company that's been doing a lot on this is Link, and Calvin's going to be talking from their viewpoint. But it's not easy to do because it involves doing forward-looking information. And I feel that many of the companies that say that, yes, we're doing TCFD, what they're doing is they're setting up the governance level, but they're not yet into doing the details on the metrics, the risk management, and reporting those metrics. But the timetable is going to have to accelerate, and we have the ISSB exposure draft out now, and ISSB has said their firm intention is to turn that exposure draft into a standard by the end of the year. And we have IOSCO, the international regulator, saying that they will be accelerating the requirement for it to be adopted. Linked to that, just yesterday, the World Meteorological Organization published a report saying that one of the years in the next 5 is likely to see an average annual temperature of more than 1.5 degrees centigrade above the 1850-1900 level. So things are now starting to move very rapidly on the physical climate side, and rapid action to counter that is needed. So we've got the ISSB standards out. We've also got in the US, their SFC has issued a standard on climate disclosures, and the Europeans about to issue their one as well. So we've got a sort of almost historic time of, never before and probably never again will we have so much attention being paid to this. Now, in this webinar, we're going to try and address 3 questions. So, firstly, what have we learned so far on implementing TCFD-based management and reporting? Because it's not just the reporting. That's the easy bit. The difficult bit is getting the management organized. Secondly, when will the debt and equity investors, when they look at their terminals, be it a Wind, Bloomberg, Reuters terminal, when will they have comparable, assured emissions reporting and indications on ability to reduce towards net zero for all the companies, so they can use that comparable data for their investment decisions? And the third question is, well, when will board decisions be adequately informed as to their impact on the projected ability of their company to get to net zero emissions, their projected abatement capacity? So we have 4 panelists. In order of speaking, Megan Tang, who's head of corporate finance at Hong Kong's Securities and Futures Commission, is going to provide the regulator's point of view. Secondly, we are going to have Calvin Kwan, who's the head of Link Asset Management Sustainability work, looking at their work on fixing a path, planning a path to net zero. And then Cyrus Kwan, who is a partner at PwC, is going to provide insights into assuring company TCFD reporting, assuring this forward-looking information. And finally, Richard Manley, who kindly joins us from London, I believe, is the head of sustainable investing at CPP Investments, which manages the pension money for 20 million Canadians. And he will be talking about how the information from companies can be made usable by investors. Richard's also got another hat, which is that he chairs SASB's Investor Advisory Group. So he is a good person to be putting the investor's point of view on how this information can be made actionable. So with that, I would like to hand over to Megan. Please, can you put your Q&A, your questions into the Q&A so that we can cover them when we get to the end of the panel discussion. Megan, thank you very much.
Right. Robert, thank you. Thank you for the introduction and the opportunity to speak to this audience, and hello to you all. As many of you would know, the momentum has been building for quite a while now to develop a set of climate and sustainability reporting standards that are universally adopted and that provide consistent, complete, comparable, and verifiable climate-related financial information to help investors' decision-making, not least because this is thought to be an effective way to hold companies accountable for their carbon footprint and ultimately, we hope, through that to bring down carbon emissions. And as Robert mentioned, the ISSB consultation has been ongoing. The exposure drafts were published at the end of March this year, and the standards are targeted for issuance by the end of this year. Now, if done, this will be a significant milestone in the pathway to global convergence on a baseline set of sustainability disclosure standards to meet investors' information needs. The IOSCO, the International Organization of Securities Commission, which some of you may know, is chaired by our CEO, Ashley Orders, is separately assessing the exposure drafts with a view to endorsing the standards for use by member jurisdictions once they are adopted. Now, against this background, the SFC and the exchange, Hong Kong, and most, if not all, of leading financial markets around the world have been working to develop their local regulatory frameworks for adopting the ISSB standards. So, again, as Robert has mentioned, in March, the US SEC proposed new rules that would require public companies with larger public float to provide audited financial statements containing climate-related financial impact and expenditure matrix, reports on their greenhouse gas emissions, and also disclose details of how climate change is affecting their business. The EU published their public consultation on the draft EU Sustainability Reporting Standards under the CSRD, the Corporate Sustainability Reporting Directive, in April. And similarly, the UK, Canada, New Zealand, Singapore, they've all announced plans to mandate TCFD-aligned reporting requirements for their public companies. Here in Hong Kong, the Green and Sustainable Finance Cross-Agency Steering Group, the CASG, which is made up of all the local financial regulators, MA, the SFC, the IA, as well as the stock exchange and the government, have committed to align our disclosure requirements with TCFD's recommendations by 2025 across relevant sectors, and that would include listed companies. To achieve this, the SFC and the stock exchange are working on a roadmap for mandating ISSB-based climate reporting requirements for our listed companies. Now, some of you may know the July 2020 amendments that were adopted to the Stock Exchange's ESG reporting guide already introduced some aspects of TCFD's recommendations, including Scope 1 and 2 emissions reporting on a comply and explain basis. Since then, the Exchange has been working on a draft set of rule amendments based on the currently based on the ISSB exposure draft, with a view to launching a formal public consultation as soon as these standards are formally adopted. In short, climate-related financial reporting is an eventuality that's very much upon the doorstep, and every market participant should, if they have not started already, be preparing for this transition. Now, like regulators across the world, the SFC and the Exchange are dedicating substantial resources to studying how to translate the expected ISSB standards into actionable and enforceable rules here in Hong Kong. I can only mention at this point that it is not a straightforward process. So, for example, an overarching principle underpinning both the ISSB General Requirement Standard, the S1, and the Climate Standard, the S2, is the concept of materiality. Now, the concept of materiality is, of course, already well established as a disclosure and financial reporting standard under securities regulation in many jurisdictions. The application of this concept in the context of climate-related financial reporting, however, is new. And there's certainly concerns among some quarters that notwithstanding the ISSB standards, we will still see significant disparity in how this concept is interpreted and applied. It remains to be seen whether additional guidance will be provided by either ISSB or even IOSCO in terms of the regulation rulemaking in this regard. There's also a lot of discussion surrounding the question of scaling and phasing the regulatory requirements to zero in on aspects that would provide the most useful information about a company's carbon footprint whilst taking account of local conditions. We're all keenly aware of the importance and the urgency of making progress, yet there would be little sense in introducing rules that a majority of regulators would be unable to comply with from day one. Our regulations must be carefully designed to promote and incentivize effective and universal adoption as quickly as possible, whilst taking into account our regulators' capabilities and the real challenges that they face. There can be flexibility for raising the bar as the capabilities expand. Again, this is an area where guidance may help to facilitate implementation and foster greater adoption and compliance in the medium term. Now, we believe that the challenges faced by Hong Kong-listed companies in this transition process are not unique. As regulators, the SFC and the Stock Exchange welcome public discourse, such as this webinar, to promote understanding of the issues that need to be resolved and build greater consensus regarding the way forward. Through the SFC's participation in IOSCO's Sustainability Finance Taskforce, we're also working with regulators in other jurisdictions to promote greater consistency in rulemaking across the region, not just in terms of disclosure requirements, but also related aspects such as audit, assurance, enforcement, and eventually digitalization. As a leading platform for enterprises in China, we see an opportunity here for Hong Kong to distinguish itself as a pathfinder and standard bearer for companies in this part of the world that may face transition challenges that are different in some regard from those faced by companies in other regions. It is our goal to set a path that is ambitious and yet practical. So with that, I will turn the discussion over to our panelists and look forward to hearing their valuable insights and experiences on this important journey. Thank you.
Thank you. And Megan, I understand that as a regulator, you are now going to move yourself to the audience rather than stay in the panel discussion. Is that your intent?
Yes, Robert.
Okay. Well,
very much here to listen today.
Yeah, well, thank you very much. It's nice to know that you're going to be listening to what the rest of this is going to be saying. And so with that, I would like to invite Calvin Kwan, who's the head of sustainability at Link REIT, to talk about the practicalities of managing a transition to net zero and reporting on it. Calvin, thank you.
Thanks, Robert. Thanks, Megan, for the introductions as well. I think that sets the scene quite well for what we're dealing with here in Hong Kong and how we need to move forward on TCFD and net zero. So let me take some time and just a quick background of kind of Link REIT. If those of you who aren't familiar with Link, we're a real estate company in Hong Kong, managing a portfolio of properties spanning mainland China, Australia, UK, and Hong Kong, primarily retail assets, but we've expanded since into office spaces and logistics as well. For us, as Robert mentioned earlier, TCFD really kicked off in about 2017. Our interest in TCFD started back in about 4 years ago, roughly around the same time, and really stemming from questions that our investors were asking. How is Link REIT responding to TCFD? What's going on, and so forth. And at that time, I think it's safe to say that there were not very many methodologies that were available for companies to understand what the climate impacts were on their portfolios. So we actually spent quite a bit of time piloting different ideas, different initiatives. We were one of the pilot participants in the UN Environment Program's TCFD methodology development for the real estate sector. Under that program, we used the climate value at risk, which is now a tool that is, I think, owned by MSCI. And we went through and put our portfolio through that assessment to find out what the financial value what the financial value at risk was for the portfolio. At that time, I think it was the results were actually very favorable. It gave us a good insight into how to prioritize our properties. The challenge, however, was the methodology was very Eurocentric. A lot of the proxies, a lot of the data were using European databases, and there weren't many options for Asia Pacific. Now, fast forward 2 years, and then we piloted another program called the Carbon Real Estate Risk Management Tool, CREM. And that one was a little bit better in the sense of having more granular data, but a lot of that, again, was very focused on the European side. However, the difference in this situation with the CREM model is that it gave us a lot more insight into some of the Scope 1 and Scope 2 emissions and some of the potential transition risks that our portfolio would face as well. The good thing from this model is that it gave us an option to prioritize the properties that we have and identifying specific areas where we might need to focus on some of the emerging physical or transitional risks. I'm happy to say that our portfolio is primarily resilient according to the physical risks that we face. Now, if we go through TCFD itself, there are 4 pillars that it asks us to report on, governance, strategy, risk management, and the metrics itself. From Link's perspective, on the governance side, our TCFD climate resilience approach is very much a board oversight issue. This is something that we report back to our ARMC, our Audit and Risk Management Committee, every quarter on the progress, where it's going. We've also set up a Sustainability Advisory Committee comprising our chairman, who is chairing that particular committee, CEO, and also COO. We have independent non-executive directors that sit on this committee as well as myself. Now, as an advisory committee, we also have external experts on climate change, on climate resilience, climate transitions, and they're from all around the world as well. So this gives us good feedback into what are the emerging issues that we have to be concerned about, how our methodology is developing, because the TCFD methodologies are still being developed right now. So this gives us insight into understanding where we are and how we move forward. At least it does also fall in compliance with HKX and SFC's requirements that climate is a board issue. Coming down to the other 3 pillars, for me, for Link, the risk management approach was really much one of the key drivers of our look at our portfolio assessment, looking specifically at what are the physical risks our property portfolio is exposed to. One of the key challenges that we face is with so many of these different physical risks, which one should we focus on? For Link, we decided to focus on flooding, primarily because this is something that people can relate to and understand. Yes, we will have heat issues as well, but those can be brushed off by the general public as a sudden spike in a day, or people can acclimate to it by going into air conditioning, so they forget about this issue. So we decided to look at flood, and this year we've actually done a flood assessment at the, I think, 5 to 10 meter granular level for our GBA portfolio. So this covers all of our properties in Hong Kong and the Greater Bay Area, looking specifically at what are some of the key flood areas in GBA, what are some of the infrastructure issues that we may have to consider, and because we have a very good level of granularity, we can actually identify, are there any hot spots at the asset level that we may need to shore up. So that's been very useful and instrumental in helping us drive our climate resilience. The good thing about this as well, from a risk management perspective, is that we're not just looking at from risks, we're also looking at opportunities. With a good understanding of the flood tendency or projected flood tendency of the GBA, we can then also use this to make more and better informed decisions on where and how we invest in properties in this particular area. We'll likely be expanding this model and methodology to our properties in northern China and also Australia as well. Coming down to metrics, with being a ARMC issue, we do make sure that we report back on key metrics, whether it's carbon intensity for all of our properties. That's probably the key one there that helps us deal with some of the transitional risks that we may face. And then on strategy, I think that the strategy pillar is just developing now. I mentioned earlier on that with our flood assessment, it gives us insight into where we can invest, how we invest, and that will eventually form part of our strategy, and that's still developing. So despite working on this for the last 3-4 years, we're not very far ahead. I think any organization that wants to join or participate in these methodologies can catch up quite quickly. The beauty of the real estate assessment that I mentioned with the climate value at risk and the CREM tool is that a lot of industries are tied to real estate or physical assets. So by default, you can put in coordinates into these models and find out some of the issues that your portfolios might have. Now, if I can transition over to one of the topics that Robert mentioned, net zero. 2 years ago, we announced an ambitious target to achieve net zero by 2035. The reason why we set 2035 is to make sure that it's a short enough time frame that people that are helping us develop this framework and strategy will still be around to see it through, right? So this is part of the ownership and accountability that we wanted to encourage. 2035 also reflects a good enough amount of time to allow for technological advancements, which will help us on the energy efficiency and alternative energy side as well. Now, we've actually set 2018 as our baseline. The reason we've set 2018 as our baseline is primarily that was the last year that we've had normal energy and electricity consumption. If I backtrack very quickly, we've actually achieved a 40% absolute reduction on our energy consumption using 2010 as a baseline. So moving forward, we've started to set 5-year targets to reduce our emissions further. The first thing is that we have a 5% electricity reduction target by 2025 and a 25% carbon intensity reduction target again by 2025. Between 2025 and 2035, we anticipate the path to net zero will encompass ongoing energy efficiency measures. It will also include on-site renewable generation. The other 3 aspects of our efforts will include renewable energy procurement, purchasing renewable energy credits, and actually potentially direct investments into renewable energy. And then lastly, there will be some mix of carbon offsets as a backup in case the other 4 options aren't enough for us to achieve net zero by 2035. We've made some good progress over last year or so. We've actually identified 47 properties to install solar PVs on. We continue to work on chiller replacements for all of our properties in regards to installing energy efficient chillers. And we're monitoring how effective these initiatives are. One of the challenges and issues that we are running into is making sure that this data can be audited and verified so that we keep good track of this. So one pilot program that we are working on is implementation of blockchain to essentially have an immutable ledger to track how much carbon emissions we're saving from our solar PV, how much carbon emissions that we're emitting or responsible from our electricity consumption, our use of refrigerants and so forth as well. A lot of this is going to be contingent on having good, robust data and making sure that that's auditable to a robust standard. This actually is a good transition for me to turn the time back over to you, Robert, and then Cyrus to talk a little bit about how they've been able to work on the auditing insurance process. So Robert, back over to you.
Thank you very much. And Cyrus, very grateful you can cover assurance. The other thing, if I understand it rightly, is that the professional firms are also doing quite a bit of advisory work relating to this. You know, that when you see many different companies and how they are tackling the question of implementing TCFD, and you may be able to help some people with the way to do it. So grateful for your talk.
Yeah, thank you, Robert. I did actually prepare a few slides to facilitate the discussion. Let me try to share it here. Okay, right. I think you can.
We can see it, and if you can go to full screen.
Yeah.
Wonderful. That's good.
Okay. So yeah, thank you for Megan to share the overall big picture of the TCFD and also the ISSB movement, etc., which definitely will also impact Hong Kong. Apart from that, Kelvin just mentioned how an entity, corporate, could use TCFD to drive the performance on ESG and also to align with the net zero commitment in different countries. So what I would like to cover is more on the data part, on how as an auditor or an accountant could also play a role in the TCFD adoption of the entity. In this chart, actually, you can see that for TCFD actually is already adopted by different countries in the past few years already. But you can see that actually in Hong Kong or in China, actually the companies that are using TCFD as the framework to do their reporting or disclosure is not that much compared to other more mature countries like USA, France, UK, or Australia. So definitely there are still rooms for us to catch up in this area. And our regulators, exchange, actually they are also playing a very key role on this part. As Megan just mentioned at the beginning, actually starting from last year, the revised Appendix 27 of the listing rules, they already incorporate certain climate-related disclosure elements from the TCFD recommendations. So we see that actually more companies are extending their disclosure on how they handle the climate risk, their risk management process, etc. in this year in the 221 sustainability report. And in 225, the exchange is also expect that there will be more comprehensive and full disclosure according to the TCFD recommendations to the listed companies in Hong Kong. So we see that in Hong Kong, we are also aligning with the international expectation that we will have more climate-related disclosure in the coming future. And of course, not only ISSB or Hong Kong, the US SEC or the EU CSRD, they are all moving on this direction as well on the climate disclosure. And in order to provide more trust or quality of the disclosure to the market, actually for US and EU, they also require the entities to have the independence assurance on the ESG information by 2024. So that you can see that as an auditor or accountant, we also need to play a role in ensuring that data or the information presented by the companies with a good quality. And actually, Kevin also just mentioned data is a very key part when we are talking about the climate risk or climate disclosure. There are a lot different set of the data that a company can reference. On scope 1, scope 2, of course, the company may be easier to identify and connect the information. But on scope 3, that is related to the upstream or downstream of the operation of the entities, that may be more difficult for a company to obtain the relevant information. So the use of the technology or the use of the automation actually is very important for a company and entity when they want to collect the relevant necessary data for them to set up their target matrix in the climate journey to them. And of course, with an independent auditor opinion on their information disclosed could bring the benefit to the entity as well, to have a better comfort to the board and also to the investor. We all know that the climate or the ESG information nowadays is not only a nice to have, but it's also very important data or information which actually will also impact the share price, the business or enterprise value of an entity. The valuer, the business valuer, or the credit agency, they will also take into account of the ESG data when they are doing the enterprise value analysis of the company, or when they are doing a credit analysis to the entities as well. And the independence assurance work on the climate data could also help the external rating agency like MSCI, CDP, GSB, etc. to do the analysis as well. So this is why we are also not only talking about gathering the data, but gathering a necessary and good quality data with independence assurance is important in the market now. And when we talk about the quality or the criteria of the a good quality of the data, we normally follow these 5 characteristics. The data should be understandable, relevant to the entities, should be complete with a reliable source, and should be neutrality, is not subjective information. So this is also important to us as a CPA or as an accountant. When we review the information prepared by the company, we have to follow these 5 characteristics in order for us to provide an independent assurance opinion to the data. And when we are talking about independence assurance, normally there are 2 types of opinion that we use. One is the limited assurance. That is more like a negative assurance. That, for example, nothing come to our attention that the information or the data presented by the company has any misstatement, etc. And another one is the reasonable assurance. Reasonable assurance is at a higher comfort compared to the limited assurance. So that in all material aspects, we believe that the information and the data provided by the company is reasonable and with good quality to support. So that is more on a positive assurance. And what are the differences of the work that we have to do or consider as an auditor when we are doing limited assurance and reasonable assurance? You can see that in this chart. For limited assurance, we are more focusing on the test of details, testing on the supporting document, and doing some analytical procedures to see whether the trend and the analysis, the movement of the data are reasonable. But for a reasonable assurance, apart from that, we also need to understand more on the control procedures of the company, how they identify the relevant data information, how they review internally on the quality of the data, how frequent of the review, and up to which level of the review, etc. So we have much more work that need to do under a reasonable assurance engagement compared to limited assurance. And of course, to a company, when they choose whether they want to obtain a limited or reasonable assurance, they need to also consider their own situation as well. For example, whether they think that the information is robust enough to up to a reasonable assurance level. And of course, they need to spend more time to work with the auditor to provide the necessary information to support if they want to go for a higher level reasonable assurance opinion. So there is pros and cons. It depends on the situation of the company, the readiness of the information, the internal control status of the entity to determine whether they are aiming to get a limited assurance or a reasonable assurance opinion. And just to share a case study that on a recent report that PwC issued for Aviva, an insurance provider company. In the past, we only provide a limited assurance opinion on Aviva ESG or climate data. But as we discussed earlier, the information is just more important to the investor or to the board or to the stakeholders. So the audit committee of the company, they would like to enhance or upgrade the opinion from a limited assurance to a reasonable assurance in 221. And this definitely also increased our work and also the communication that we have to do with the company. And what we finally do is actually in TCFD framework, the 4 pillars, we focused on the targets and measures and the information that the company disclosed in their sustainability report. And in this page, you can see in the left-hand side, we identify which data that we are comfortable as an auditor to provide a reasonable assurance. And that actually include those scope 1, scope 2 environmental data, and also how this 2021 data against the 2010 baseline. That is how they set the target and the measures and compare the performance against the baseline. So from this experience or this exercise, actually this is very important to give a trust to the capital market or to the investor that the information or the target that's prepared by the entities is actually reliable, complete, and with a good source of the information to support. So that is the value that why we have to do a independent assurance work on the data. And this is also what the regulators or the international framework ISSB or the US SEC or the EU CSRD is asking the entity to do a independent assurance work on their data to provide a greater trust to their information on the climate or ESG target. So this is what I want to share as an auditor or an accountant, that we can also focus and play a role in the TCFD journey to assist the company to upgrade their quality of the information provided. So back to you, Robert.
Thank you very much, Cyrus. The next person I would like to invite to talk is Richard. And with Richard, I presume we're going to be moving a bit towards the issue of forward-looking information when companies are talking about how they are going to get to net zero in the future. So Richard, thank you very much. If you could illuminate.
Thank you for the opportunity to join you all today, and sorry I can't be there in person, but I look forward to getting back to Hong Kong sometime very soon. As Robert said, I'm going to share today the high-level expectation of issuers and then try and get into some of the detail here. But I'd like to make clear that this is the most significant business risk and opportunity of our time. Most end markets where issuers operate have committed to being net zero by the middle of the century, whether that's 2050 or 2060, we don't need to quibble. It's beyond the forecast horizon, but is clearly into shaping the terminal value of publicly traded securities. And as an issuer, not being net zero when the regulatory backdrop of the markets you will be operating in require it is a fundamental source of business risk and potential value erosion. If you are not planning to be net zero when the regulators in the markets you operate intend to be there, you are effectively pursuing a strategy that we will reasonably have to conclude is going to be inconsistent with the prevailing macro environment that you're operating in. Okay. Now, as a result of this, our long-term expectation is that companies that fail to decarbonize their business will, over the medium term, lose access to capital. There was a comment earlier on with respect to materiality. I'd just like to frame some expectations around this. If a company, its suppliers, or their products or services that they're providing require the emissions of greenhouse gases, that business has transition risk. If the economies that they sell to, source from, or operate in are likely to be subject to future acute or chronic physical risks or changes in behavior resulting from those, the business has physical risk. If you don't believe you have either of these, I'm curious to understand how an issuer arrived at this conclusion, as there are very few businesses can claim that climate risk is neither a material business risk or opportunity for them in the medium term. Next, moving on to our expectations. We appreciate that climate risk is new and it's complex for many, but delaying the need to manage this risk is not a viable strategy and is only going to raise the order of magnitude of this risk over the medium term. Now, our position on this with respect to the company is very clear. As with all material business risks and opportunities, this is the board's responsibility. Our expectations of boards is that they provide oversight and counsel to ensure that all material business risks are integrated and considered in the shaping of strategy, its operationalization, and the issuer's communication with the market. It's complex, but this cannot be an excuse. And as that then pertains to climate risk, we believe that the expectations that we have of a board should now be this, that they are able to demonstrate there is clear independent oversight of climate risk within the boardroom, that they have ensured the executive has identified and quantified both climate risks and opportunities for the business, and that the insights derived from that are being integrated into strategy, its operations, and reporting, and to the extent appropriate, target setting. Now, having already during the course of the session touched upon the TCFD, that should sound very, very familiar as it follows the pillars of the TCFD framework. CPP Investments is an investor, a TCFD member, and also importantly, an issuer of bonds. In advocating for issuers to use this, we felt it would be disingenuous not to actually subject ourselves to the same. So we committed to using the TCFD framework and reporting to it in 2018 by 2021. And to all of you that are working with issuers, I will say we are grateful we gave ourselves 3 years to do this, as it did require a lot of capacity building and a lot of work to do it comprehensively. We met this commitment, but I think more important is actually that the end state is not where the value was derived. The value derived from doing this was the journey to getting there. Because the TCFD is not only a reporting framework, its pillars are the foundation for developing readiness to support climate reporting and also support fundamental capacity building within the company to confront the challenge. It wasn't easy, and I don't want to present our current state as what we expect to be the end state. We still have a lot more work to do, but I think that having done the work, we are on a strong footing to take our climate strategy forward. And I would contend, despite the challenge of doing this work, that other issuers are likely to encounter the same benefits from subjecting themselves to this. The next point I would like to make is that we should all remember that the TCFD is not a standard setter. As outlined earlier by Megan, the ISSB will hopefully be taking forward the TCFD's work to create a climate reporting standard that is going to be much more prescriptive with what data issuers should specifically report. And importantly, this is very, very critical for investors, as I want to make clear that to date, we still don't have comprehensive reporting for even a single sector of the same metric reported on the same basis for the same period and third-party assured. We have lots of data. We just don't have comprehensive reporting of the data we need to price risk and to ensure that we are able to allocate capital to the businesses able to thrive and transition over the long term. It's just one example to corroborate that point. To calculate our estimate of the fund's current Scope 1 and 2 financed emissions, we are only able today to source emissions data direct from the issuer for 35% of the portfolio's emissions. Now, I would hope we will see that expand in the years ahead, but it needs to expand, and it needs to expand for issuers if they seek to secure access to capital over the medium term. Now, changing tack to forward-looking statements, we are now seeing many issuers provide short-term targets for greenhouse gas reduction and long-term forward-looking statements that their business will be net zero by 2050. It is great to see ambition transition to commitment, but let's be clear, committing to net zero is the corporate equivalent to a human committing to run a 2-hour marathon. If I did this, none of you would believe me, and all of you would ask for my personal best. If I told you it was 2 hours and 2 minutes, you would probably give me a fair hearing. If I told you I had never run a marathon in my life, you would all laugh at me. And the reason I say that is it's very clear there is a very widespread inequality of the work done to support net zero commitments. Some have made best effort endeavors to support these commitments with very, very robust analysts, identifying specific investments they can make to decarbonize the business. It is less clear the same rigor has been provided to the guidance of others. Now, the provision of long-term guidance to the market is not new. Mining and oil companies have always been required to provide long-term production projections in order to raise financing. But when it became clear that some of this guidance was overly optimistic, market convention and in turn regulation moved to require production projections to be supported by independent reserve reports. And our proposal is that this precedent be applied to climate guidance. If companies make representation to the market that they can remove 100% of the emissions from their operations, should they not calculate and report the percentage of their current emissions that are economic now, likely to become economic over time to abate, and lastly, those that are uneconomic to abate, where there could be fundamental risk over the medium term of stranding? There are actually only 5 ways to decarbonize a business. There's efficiency measures, there's greening of power supplies, there's investing in new lower carbon technologies, there's closing operations down, and lastly, offsetting with high quality, additional, verifiable, permanent removal offsets. Now, we published a paper during COP26 outlining a proposal that all issuers providing forward-looking statements that they will be net zero should conduct or would benefit from conducting something that we call an abatement capacity assessment in order to calculate their projected abatement capacity. Now, we don't want to position this as a new initiative. We believe this workflow is highly, highly complementary to supporting all of the existing climate reporting obligations of issuers, both to quantify emissions, but also importantly, attribute them to specific decarbonization pathways. Now, the primary beneficiary of conducting this work would actually be the company, its board, and its executives. They will identify very clearly whether their short-term targets are appropriately ambitious and the feasibility of their long-term commitments. But importantly, the ability to report this will also risk or address the risk of market abuse associated with providing such long-term guidance. And subsequent to publishing this paper, we've conducted roundtables with our peers, with the strategy consultant community, and also with auditors. And the conclusion of those roundtables is very clear, that the proposal that we put forward would address fundamental data deficiencies that are prevalent in the boardroom and the market, that the strategy consultants believe this approach would accelerate transition planning, and that they are themselves able to support clients in conducting this work. And perhaps of no surprise, but greater relevance to all of you, is that the audit firms believe both the process that we proposed and the resulting reporting could easily be subject to assurance. Now, I'll spend a little bit of time now on what is this proposal. Very simply, that all companies prepare baseline greenhouse gas emissions reporting and then attribute their emissions to the five different buckets, effectively. The first is the percentage we can address through efficiency, then through greening of power supplies, and then through investments that are economic to sanction today. The three of those sums effectively current projected abatement capacity, or in lay speak, proven abatement capacity. The next exercise seeks to simplify all of the scenario analyses that companies are doing as a result of the TCFD work, and simply say, apply a scenario that is common to all, and that is no change in regulation, no change in technology costs, but simply the flexing of a shadow carbon price to first $75 a ton, and then $150 a ton to recalculate the investments that would prospectively become economic at those shadow carbon prices. Now, some say that's conservative, some say that's optimistic. What I would say is, by virtue of taking a conservative position on regulation and technology costs, those numbers are almost certainly to be revised up over time. And this framework would allow for the annual restatement of capacity as it increased. Lastly, we propose that abatement that is not economic at effectively until you are over $150 a ton should be identified as currently uneconomic, and the investor incentivized to disclose the share of that they anticipate they would run off, the share they would seek to offset, and the share where, while they are actively diligencing future abatement technologies, they believe that over time could be moved into the probable or proven buckets we identified. And we believe that in doing this, we'd not only see an acceleration of decarbonisation, but importantly, the market would be far better placed to price risk, and importantly, allocate capital to those businesses able to fundamentally decarbonise the real economy. Now, we appreciate this is hard. We also know that people want to believe and represent the fact they have their arms around this issue. As a species, we love to oversimplify, but this is not a risk we can actually oversimplify. We're not even close to the end of the capacity building exercise that we need to conduct to confront this challenge. At best, we're in the second innings of what I'll remind you all is a 9-innings baseball game. We have a long way to go. Speaking to an advisor last week, he told me that he believes that many of his clients are probably still only in the changing room warming up. The accounting industry is clearly working out how it can play a role in the transition. The answer is clear, and I think it spans advisory, readiness, and assurance. This change is not only happening, it's accelerating, and I would say now is the opportunity for all of you to step up and play your part in supporting your clients in ensuring their businesses thrive over the very long term, to preserve access to capital, and to continue to create wealth for their economies over the long term. With that, Robert, I'll hand back to you.
Thank you very much indeed. And I would like to firstly see if Cyrus or Calvin has anything they would like to say in response to what you're either making a statement or asking you a question to elaborate on part of what you said, Richard.
All right, Robert, I'll have a stab at that first. Actually, everything that Richard said resonates with Link and resonates with me very well. I took a couple of notes down on here, and you know, Richard, what you were talking about in sense of looking really the first 3 steps that we can be looking at: energy efficiency, power supply, and then ongoing investments. That's exactly how we're looking at this. And one of the key things that we're looking at and we're actually figuring out is actually the earlier you are, the earlier you get started on this progress, you don't have to look at this from a OPEX perspective. You look at it from a CAPEX perspective in terms of figuring out what types of returns you might get from some of the options that we're looking at here. So, I mentioned earlier on my presentation, we're also looking at the possibility of investing in renewable energy as direct investments. And that was something that we hadn't considered before we started to do this baseline study of our emissions and figure out how will I actually achieve this by 2035. So, we have mapped out by 2035 how much we'll be able to achieve by energy efficiency. We know roughly what the grid improvements will be. And then, that gives us really that remaining amount. One of the interesting points, Richard, and then maybe I'll ask you this question, is that there has been a lot of debate about the applicability of carbon offsets as part of net zero strategies. I'm surprised, and actually I'm pleasantly surprised that from your side you do support this quite well as well. Could you actually provide a little bit more insight into that thinking, because there has been a lot of debate about carbon offsets.
Absolutely, Calvin. And maybe I'll just respond to the first part of your observation there with respect to decarbonizing in the real estate sector. This is not just a concept now, we're starting to apply it to our portfolio companies. And what we've quite quickly actually identified is that once you do the work, you start actually identifying that there's opportunity lying around all over the place. I don't want to suggest it's all easy to do, but simple stuff that's already in the maintenance plan, the upgrading of elevators, the upgrading of other infrastructure that is energy intensive in the built space, it's often already in the CapEx plan, but brings with it tangible improvements in energy efficiency. On top of that, your point, modeling what is going to be happening to the grid that you're consuming from is already going to give you line of sight of a certain element of emissions that are going to be addressed by the investments of others. But then I think also importantly is the other investments you can start to pursue that are currently economic. And in the work that we've been doing, we've been applying a 10% discount rate, requiring investments effectively to generate a 10% IRR. And we've actually found a far bigger percentage in some of the real estate assets that we started to look at are eminently economic to be sanctioning today by virtue of actually having done the work. The other thing that I think we found interesting is where investments are not quite economic today. First of all, knowing what they are, which technologies those are, immediately allows you to engage with peers. It allows you to engage with those technology providers to better understand how you should expect their cost to improve over the medium term. And also to think about whether you want to start piloting in specific assets certain of these technologies to help see if that can scale the technology and lower the cost for broader application across the portfolio. So I think that the way, Calvin, you've identified the experience you're having is certainly something that we're also starting to see in the real estate arena. With respect to offsets, look, I think we need to be very, very clear here in how they're used and how they are represented. The Taskforce for Scaling Voluntary Carbon Markets did a lot of work over the last 18 months, effectively seeking to agree a definition of what would be a high-quality offset. And the first thing is very, very clear. There are avoidance offsets and there are removal offsets. To date, a tiny percentage of all of the credits that have ever been traded are removal offsets. The vast majority seek to cover avoided emissions. You have heard very specifically, I said that the language that I used earlier on was offsetting with high quality, additional, verifiable, permanent removal offsets. And that is to attain the end state of net zero. And I think, listening to the audience that don't know the specific elements of those, but additional means the investment would simply not be made were it not for the stapling of the incremental revenue associated with the carbon credit being stapled to the asset. Verifiable, both the baseline and the removal of emissions needs to be verifiable. Permanent, it has to be. I think where we're coalescing now is over 100 years, but we are seeing several initiatives now defining permanence as at least 1,000 years. And the last point that we have there is removal. And the difference between removal and avoidance is one is an additional revenue line that has prevented the release of more emissions into the atmosphere. Removal is an investment that is actually taking this stuff out of the atmosphere. Now, I think where we are seeing a consensus emerge is that where corporates are proactively seeking to decarbonize the business, but some of those emissions are not yet abatable, that there is a legitimate interim claim that can be made, that is the pursuit of carbon neutrality, offsetting the unabatable emissions with high quality, verifiable, permanent avoidance credits. But I think once we get to the end state of net zero, where we have removed everything we possibly can, but there are now emissions that are uneconomic to abate, the consensus I think is clearly emerging is that at that point, the only legitimate way to present the issuer as being net zero is offsetting the residual with removal credits. And that is where we will start to, I think, look at technology-based solutions. The cost of these is falling. It's still a lot higher than any of even the highest compliance market prices we see around the world. But Wright's Law is coming to all of these technologies. It was only 15 years ago that people told us wind and solar would never be economic. And I would hope that the naysayers of today with regards to carbon removal technology will find we see a similar reduction in cost curve over time, and that these do become legitimate parts of the decarbonisation toolkit for corporates across the globe.
Richard, thank you very much. Can we focus for a bit on the near-term bit of decarbonisation? So not the end bit, do you shut the business or do you get an avoidance offset, but the near bit where, as you were saying, it's proven ability to get greener or lower carbon power, efficiency, and other technology improvements. Now, for items like that, if you say, just think about the Hong Kong property market, the story on the power is a sort of common property story. It's not specific particularly to individual properties other than where they put solar panels on the roof, and that is clearly individual and incremental. But the rate at which our grid decarbonizes is something where, you know, one could see a combination of the power companies and the government and all the rest go and do a scenario, which can then be used by the companies that are reporting. On the technology, once again, there is a set number of different ways in which one can improve the technology. I mean, a lot of it, I suspect, comes down to insulation. Which of our properties will need to be reskinned, take off the existing facade and put on one that has got far better insulation. But that can be, and so there could be a data bank of things one can do. And then a company such as Link, when it's doing what its capacity is, should be either using that data bank, or if it diverts, if it goes different to that data bank, explaining why it's justified to do that. Now, does that make some sense to you? Because I'd like your view on it, and then to hear Calvin's view, and then finally Cyrus's view in terms of auditing it.
Absolutely. So, Robert, I should probably disclose to the audience, as an Englishman sat in London, I could immediately sound now as though I'm over my skis in talking about Hong Kong real estate. But I am also a permanent resident of Hong Kong. I have my right to abode, and actually only left in 2017, following certainly 7 of the happiest years of my family and professional life. So I have lived Hong Kong real estate. It's a country that gets quite cold in winter. It's a country that gets quite hot in summer, and you can almost always tell the temperature by simply placing your hands on the window or the walls. So yes, I think it is fair to say that the building stock in Hong Kong is a real opportunity. I think part of that is the walls, but also the window. It's also the heating and cooling technologies. I think the building stock, the asset life and the residual asset lives of a lot of these technologies are obviously always falling. and importantly, the transformation that we've seen in the efficiency of HVAC technologies in recent years is considerable. So I think all of the stock anyway will be presented opportunities to drive energy efficiency as a result of the regular cycle of maintenance as we move forward. Absolutely, although it's a bigger consideration in terms of the conversation with tenants or owners, there will be a natural cycle where more dramatic upgrading of maintenance of buildings are presented, where there is the opportunity, Robert, as you alluded to dramatically improve the thermal efficiency and the glass technology that is used, both dealing there not only the thermal considerations but also the typhoon considerations we have in Hong Kong, which I think is often lost on international observers, that we're not just building buildings for heat and cooling, we're also building buildings that need to be able to be very resilient in a T8 environment. But I think as Calvin's alluded to, I think as soon as you identify where the emissions are coming from, and then can really have a conversation about which of these can we address now through what are effectively operating costs. We're going to present them probably as a capital investment, but the payback is so fast, you can be deploying this as part of the regular ongoing operations. There are then those that do need to move into capital cycles. I think, naturally, issuers are going to keep an eye on the residual asset life and seek to be updating these technologies when the asset life remains is more modest, but also as a result of that, when the inconvenience of what are quite large cap investments can be more choreographed and managed with the tenant. But I would say another big opportunity is actually thinking about the building code going forwards. We do have a large real estate portfolio. I think one of the tensions that we always see is whether tenants are ready to pay not only for better performing operating space, but better performing embodied space. And we're talking to an audience of accountants, but everybody on the line will be aware that we capitalize the CapEx associated with building a new building. And as a result of us amortizing that over the life of it, we work very hard to drive down the capital costs of buildings. But we write off the greenhouse gas emissions associated with construction. The greenhouse gas reporting protocol means they are effectively reporting in the year of their emission. How would we reframe the debate if we actually capitalized embodied emissions into the building at practical completion, and instead of leaving those emissions on the cement and the steel and the glass company, actually amortize them as an operational emission on the balance sheet of the tenant? Because I think if tenants were actually finding that the embodied emissions of the building they occupied fell into their scope 1 emissions, that the conversations that tenants would be ready to have with Calvin and his team about not only ensuring that we have the highest quality thermal performance of the space, but also the highest quality embodied performance, would reframe the discussion about demolishing and building from new, and certainly raise the value of retrofitting. But hopefully also start to scale and drive down the costs of the technologies associated with green cement, green steel, and green glass. So plenty of opportunity there. We may need some nudges. We may need to tweak some of the ways we account for this. But these are commercial considerations that need to have, where those that lead, I think, will be rewarded, and those that lag will see it in the capitalization rates for their exit multiples.
Thank you. Calvin, your response?
No, I agree with what Richard said there. And even in my presentation, I highlight a little bit of we achieved a 40% absolute reduction on energy using 2010 as a baseline. And we anticipate that there's a good double-digit further reduction coming up in the next 5 to 10 years as well. So on the energy efficient side, it's absolutely there. One of the key things for buildings in Hong Kong is really going to be the design side. Richard kind of hinted at that already. You have jurisdictions outside of Hong Kong that mandate you have to have double glazed windows, but even that in Hong Kong is not always standard. There are insulation issues and design issues that we can tweak and make, that we can implement into some of the building designs that we have that can already reduce some of the thermal loading in the buildings, and then by default reduce the required cooling that's needed as well. I guess from that, you're seeing that a lot of newer developments coming up are certainly going for the green building certifications. The common question that we often get is, does it cost a lot more? And yes, it does cost a little bit more. But if you're talking about $100 million out of a $3 billion project, it's not significantly a lot more. One thing I want to touch bases on was Richard, your comment about the embodied space. In the past, one of our key challenges was how do we get the tenants to work with us on our emissions? How do we get them to care? What we're actually finding out now is that similar to our experience where our investors are asking, hey, Link, what are you doing with these carbon emissions? How are you reducing and so forth? What we're finding out is that some of our listed tenants are having those same questions asked by the investors. So they would essentially ask, hey, are you renting in what type of property are you renting in? Is that property energy efficient? And that's actually where the discussions need to start happening a little bit more between the landlord Link and some of our major tenants. How do we make sure that we can upgrade and enhance the properties so that the embodied carbon is lower, or that it is more energy efficient for tenants, and have that information translate to the tenants so that they can satisfy their investors' questions as well. So we're seeing that starting to happen, and we're welcoming those discussions. I think at the end of March, we host an event called Connection, and that's where we bring in a lot of our tenants, vendors, contractors, service providers to talk about some of the key issues that we're dealing with. The theme this year was Green Lease. How do we share data? What type of data do we need? I think I saw in the Q&A, there was a question on Scope 3 emissions. For our side, our Scope 3 emissions will be our tenant energy emissions, our tenant energy consumption. But in Hong Kong, as most of you know, we don't have that information. We don't have that data as landlords because that's private and direct with the power company. So what we're doing is actually working with our tenants to encourage them to report their Scope 1 and Scope 2 emissions, which again are default our Scope 3 emissions. Ideally, when you understand what your baseline is, then you can start comparing your performance with other organizations, see whether you're better or worse. If you're worse, then you can bring down those emissions, and that helps to reduce your Scope 1, Scope 2, which then therefore goes to managing Link's Scope 3 emissions. So a lot of this is really about discussion. A lot of this is about that ongoing relationship, whether it's the investor side pushing Link, investors pushing tenants, and then tenants and landlords talking about these common and shared goals. One of the things that some of you have heard me talk about at Link is this concept of business as mutual. When we're dealing with climate resilience, when we're dealing with these issues of net zero, we actually have to work with each other and align these efforts so that we can achieve this challenging goal together. Other than that, again, I think that the embodied carbon space is going to be one of the key things, especially for office tenants, as you have a lot of the MNC tenants that are looking into this. So Richard, thanks for raising that. It's certainly something that I will keep on my radar as well.
Thank you. And if I can hand over to Cyrus on this one, but just repeating the point that to what extent is it sensible or practical to have some common metrics out there, the government having worked with the power companies to say, well, if you're taking power from the grid, this is what to assume in terms of the decarbonisation profile going forwards. If you're looking at efficiency, maybe there are certain items out there which can be a common assumption. Because some of these assumptions may be wrong, but if everybody's making the same assumption, then we can see which companies have got a better pathway towards zero than others. So Cyrus, I'd be grateful for your views on this and just how you assure it.
Yeah, thank you, Robert, and also thank you, Richard and Calvin, for sharing. I think first thing that I want to say is, for Hong Kong, China, honestly, what we see in the market is there are still quite a lot of rooms that real estate players or other industry players could do in decarbonization. Why I say that is because when we are doing our work as a consultant or as an auditor, actually in the last 1 to 2 years, we still see that even though when some major real estate players, they want to set their target in decarbonization, they are still pretty much conservative. They are still trying to just calculate in each year the minimum work they can do to reduce the energy used, the electricity that they can use. So they set up, for example, like over a 10 years or even 15 years, they are still just decreasing their energy usage for maybe 10% or 15%. So just maybe 1 or 2% in each year to reduce their carbon usage, their emission, GHG emission. But what we can see now, more and more, really more investors in the market are concerning about this information or the target. What we see in the market or what we heard is even for some result announcement or even with some meeting with the investor, now the investor is not only asking about those financial performance, they will also ask about the sustainability target data information that provided by the company and how this compare to other peers in the market. And they will also challenge the entity if they are too prudent or conservative compared to other peers. They will just compare that other companies are already setting the target up to a certain percentage of decrease over a certain period, right? Like actually they are very aggressive, right, in the market. But some companies they have the pressure now to catch up. And what we see is for some project, actually we work together with those engineering consultants in the market that to revisit the portfolio or the emission of the building of the client, of the real estate payers in the market. They didn't think about that actually they have a lot of different measures or opportunities with the technology to measure their usage that they can do. Actually, they are quite left behind to some extent. So there is still quite a lot of things that they can do. And this is one point. Another point that we looked at in the market is the scope fee data that Kelvin just mentioned. Because in the past or nowadays, still quite a lot developers or those asset owners, they are only focusing on the scope 1, scope 2 data of their own emission. But as a property investor, actually, if they are purely just own the asset and rent it out, then most of the emission actually is included in scope fee, in their tenant emission. Their own portion as a property management, property manager, etc., is quite limited compared to the usage of the tenant. So we also can see that the market is also asking for this kind of scope fee data. And this is actually also aligned with what we said at the beginning in EU or in US or the ISSB, they all requesting for the scope fee data. Because no matter for which industry you are at, normally the scope fee data, if we consider it together as a whole, scope 1, scope 2, scope fee at least count for 40 to 60% or even more of the whole emission of the entity. So we cannot just miss out this part of the information. Although I understand that is quite difficult to gather the information in the market. And as Robert just mentioned, actually we accept or we encourage the company to apply some estimation in the market, but of course they also need to do some cost check with the actual information as well to support their estimation. And also we are also seeing that actually as an auditor, when we are discussing on the scope of the assurance with the entity in the past, we always focused on those environmental data, scope 1, scope 2, but now actually the entity is also discussing with us on how as an independent auditor, we can provide assurance on certain scope fee data as well. Of course, not only environmental, sometimes we also cover social information like the pay gap between the top management to the general staff, or even those female versus male, etc. So we see that the market is developing. In the past, it is more focused on some basic information, but now they want to extend that to scope 3 and more advanced information that want to be being assured, obtain the assurance from an independent party as well. So
thank you.
Yeah, Robert, this is what I want to supplement. Yeah.
Thank you very much. So if I can be a little bit provocative, question really for Richard, and then I'd be interested, Cyrus, in your answer to this. One, there's an alternative to getting your report assured in terms of providing confidence, and that's to get it rated, to have an MSCI or Sustainalytics or somebody else. So say, Richard, we had your vision of the way things should go, of companies reporting their ability to get their current carbon footprint down to zero in these 5 different buckets, how much from efficiency, how much through greening the power supply, etc. And then you have rating agencies rate the quality of the company's work in terms of developing and reporting its abatement capacity in those buckets. So that would be an alternative way of getting somebody like yourself as an investor, getting assurance or getting comfort that these reports are valid, as opposed to having an audit. So I would be interested in your thoughts on that. And then Cyrus, on your side, one of the questions that's come up is saying what actual experience has there been in terms of doing reasonable assurance on companies' ability to get towards net zero. So Richard, if you could help me first.
Yeah, Robert, I think it's an interesting question. I think actually the precedent regulation we have requiring the extractive industries to produce an independent reserve audit is going to lean me towards an answer that is, I don't know why they would need rating, because we don't see the ESG raters provide an independent appraisal of an oil company's reserve report. You know, as long as their auditor has assured the process and in turn assured the numbers that are on the page, the market convention has moved very quickly to say, if you have the hydrocarbons in place to produce your production guidance, we'll be ready to provide you finance and we'll value this way. And I think you turn that around and say, if the company has demonstrated through the detailed analysis of each of the sources of emissions, the cost associated with the abatement of that, and whether that is one of the buckets that's proved economic now, likely to become economic over time, or potentially uneconomic until we see some real transformation in technologies, I'm not sure why we would need independent appraisal. Now, I assume why, I do appreciate why some institutional investors place emphasis on the third-party assurance of other ESG data, but I think when the rubber hits the road on climate, transition risk really comes down to the simple fact of whether or not you can abate emissions economically. And that I think is it. And but one more thing, just on Robert, we've touched on a few points earlier on with regards to this. I think the beauty of that data point then allows you to distill a conversation into one of two things. Does the issuer have the capacity to abate its emissions? And then two, does it have the propensity or the motivation to deliver upon that capacity? Because I think as we move forward, where we identify that companies that have the capacity to abate, but have not pursued it, I think that is going to become reputationally very risky, and probably more risky than companies that don't have the capacity to abate, but would give their eye teeth to do so, and are providing essential services. Which is worst at that point? Those that could but didn't, or those that wanted to but couldn't? And I don't think we've got to that level of debate yet, but I suspect we'll be there in the not too distant future.
Thank you. Cyrus, we only have 5 minutes. If you could give me a quick answer on the question I asked, and then I want to go back to Richard with one more question before we close.
Yeah, sure. I will be quick. I think one of the questions that is what is the additional work that we have to do on a reasonable assurance compared to limited assurance. In the market, I will say that you can see that for the CPA firm, not only PwC, but with other Big 3 firms, actually we tend to do limited assurance in the past few years. The reason is because for reasonable assurance, as I mentioned earlier, the control and the quality of the data are very important for us to upgrade the information. But as I mentioned in the Aviva assurance provider example that I just called, actually we are also trying to upgrade that work to a reasonable assurance to, actually this is fit for the demand of the investor and the regulators. They are asking for a higher level of the assurance from the independent parties. So internally at PwC, of course, we also have a lot of debate, discussion that what kind of control and additional information that we have to obtain in order to provide a reasonable assurance to the entity information. And that is what we do for Aviva case earlier. And of course, the first thing is that the company itself has to have an internal control. I can say that actually a lot of companies, they are not that, they don't have a very robust internal control on the data collection process because they rely on specific BU or overseas subsidiaries to provide information. But how the responsible parties, no matter it's the ESG committee or the board of directors, how they review such information is lack of support to some extent for some companies. So we have to assess whether the company has a robust information control in place for us to upgrade that in a reasonable assurance. And as I shared earlier, actually this is also the request from EU and also in US in the future that they require to extend that assurance work to reasonable assurance as well. So,
thank you very much.
Robert.
So Richard, time is running out, I'm afraid. Question, so you made this proposal at COP26 for a way in which companies could report their ability to get to zero, their abatement capacity. Now, as you say, TCFD is not the standard. The standard is going to be the ISSB one. Are you hoping that this proposal you made will become part of the ISSB standard? If so, how?
Robert, I'd love it to. Certainly, that is the wish. How obviously would be that everybody responds to the public consultations saying everything that's proposed is fantastic, but wouldn't it be extra fantastic if we also had issuers conducting abatement capacity assessments and reporting projected abatement capacity? I think everybody's at liberty to do that. The paper was published under something called Creative Commons, so if you share that view, you're more than welcome to do so. I think the other opportunity here, though, is actually grassroots. We've started doing these now. The transformation of discussion amongst the management team and the board, being armed with the insights as to how much of this is possible, is truly transformational. And I think for any of you that have got clients that are struggling to work out how to eat the elephant, this is hard, right? Decarbonizing a business is hard. It is the boardroom equivalent of eating the elephant. You need to do it one mouthful at a time. If you have clients that are struggling to get their arms around the challenge, put it out there, conduct an abatement capacity assessment, and put it in the buckets and see what the numbers tell you, and be guided by the facts and not drown under scenario analyses.
Thank you. Well, and putting it back to you, have you done that yourself? You have some assets which you own directly. Have you done the abatement capacity calculations for those assets?
We have started. We are now starting to get the initial readouts. The conclusions are, I think, better than we'd hoped in terms of the benefit to the board and the management team. What we're starting to learn is that there is some dependency on the greening of the grid in the specific markets you operate. We're finding probably more than we'd hoped is possible and economic to abate now. We're also seeing real benefit in understanding the bits that aren't economic to abate, because as soon as you actually distill that to a small handful of processes rather than potentially a vast unknown, you really can start to, one, agree when you'll plan to deal with this, because if it's not this decade, then when will we likely need to do it? And also start to engage with the suppliers of the technologies that could actually become economic to determine, when you may be ready to deploy those to save those emissions. So, so far, I think the conclusion would be at least as good, if not better than we envisaged, and certainly proving decision useful to actually inform a decarbonisation strategy.
Thank you. Kelvin, final word?
No, I think that we've got a long way to go, and I'm glad that we have CPP Investments kind of leading the way, guiding us. We also have PwC to help us figure out how things move forward, and I look forward to working with all of you.
So I would like to thank all three panelists here, plus Megan, for her valuable contribution at the beginning, and wish everybody good evening, or good morning in terms of Richard's. Thank you very much.
Thank you for having us.
Thank you.
Bye.
Bye-bye.